Hey, Dave. Good to see
All right,
you again.
welcome to
I
today's.
appreciate.
Yeah, for
Go ahead,
Go
Carl.
ahead, Matt.
Thanks for joining today's webinar, everyone.
All right. I
We
was just going to
will
say,
we'll wait for a few people more people to come in. So if you're need to go to the bathroom or grab something to eat really quickly, please do so now. We'll get started in a couple minutes.
hey, Dave. Good. I appreciate you making time to provide this information to us and our clients and
for sure.
invitees.
For sure. Appreciate you having me on, Carl. Always a pleasure.
Are you going to be?
Oh, cutting out a little bit there. You able to hear him all right, Matt?
I did not. Carl, you didn't hear
I
that.
say, are you
What
going
did
to
you
be
ask?
back in Florida anytime soon?
I sure hope so. I have no plans for it, but I definitely try to come down once a summer or so.
All right, it is 12:02 Eastern, so we'll go ahead and get started. So again, thanks everyone for being here today for today's presentation, which is where smart commercial real estate investors are deploying capital now and how retirement funds fit in. Quick disclosure before we get started. Camoplan does not provide investment advice or endorsements due to the nature of our industry, so today's presentation is entirely for educational purposes only. Camoplan is not an investment advisor, CPA, realtor, or attorney. If tax, legal, accounting, investment, or other similar expert assistance is required, the services of a competent professional should be sought. All information and materials presented on Camoplan webinars and podcasts are provided for educational purposes only. We strongly encourage you to consult with your attorneys, accountants, and financial advisors before entering any type of investment. All right, very good. So we got that out of the way. Dave, let me throw up your screen there. Give me 1 second.
Good.
And just a quick introduction. So we're being joined today first by David Shoemaker from Marcus Millichap. Marcus Millichap is one of the largest commercial real estate brokerage firms in North America, specializing in investment sales, financing, research, and advisory services. Founded in 1971, the firm has built a national platform connecting investors with opportunities across property types, including multifamily, retail, office, industrial, and hospitality. David Shoemaker with us today is an investment real estate professional with Marcus Millichap, one of the nation's leading commercial real estate brokerage firms. He specializes in helping clients navigate the acquisition, disposition, and valuation of investment properties with a focus on delivering data-driven insight that we're going to hear about more today, and strategic execution throughout the transaction process. Also with us today is one of Camoplan's co-owners, Carl Fisher. So Camoplan, for many of you who already know it, but just as a reminder, Camoplan is a self-directed IRA administrator founded with the goal of helping individuals take greater control over how their retirement capital is invested. For over 20 years, Camoplan has provided thousands of investors with the ability to use IRAs and other retirement accounts to invest in alternative assets, such as real estate. Carl Fisher, as I mentioned, is one of the owners and is a third-generation real estate investor. He works with investors, financial professionals, and asset providers to help them understand how self-directed retirement accounts can be used to access alternative investments. All right. David, the floor is yours. But before we get started, I just want to check. Carl, can you hear us? All right. Carl's having some technical issues. That's okay. David, he might join us, but you can go ahead and get started.
Gotcha. Thanks a lot, Matt. I appreciate the introduction. And just to touch a little bit more on Marcus Millichap, my company, and what we do. Again, we're an investment sales firm, so we do brokerage, and that is all that we do. We help clients and advise them on the sale of investment grade properties across the country. We have about 80 offices across the country, ranging anywhere from New York City down over to Los Angeles, down into Texas, Florida. We even have offices up into Canada, and we have focused and grown our business on specialization and collaboration. So I specialize mostly in office and industrial properties in Northeast Pennsylvania. But our firm as a whole covers every asset class for commercial grade, investment grade properties across the 50 states and then even into Canada, as I said. And I'm here to talk a little bit more about how COVID has changed the commercial real estate market. Obviously been a much different market than it was in 2019 and prior. So I'll get into that a little bit, explain the asset types that have become more desirable, those that have become less desirable, and just the general change in the market with underwriting and cost of capital and whatnot. So going in, just looking into a little bit more about what post-COVID commercial real estate looks like. A lot has changed, and I think the biggest change that we've seen has been the love for industrial real estate. Before COVID, industrial real estate was really seen as the redheaded stepchild of commercial real estate. It was there for companies that needed it, but it wasn't used quite as much for investment grade. But for the first time ever in COVID, industrial real estate was the number one asset class that was chosen. And for the last 5 years, it has been the biggest growing asset class in commercial real estate. So that's been the biggest changes that we've seen. And a lot of that is driven from an increase in e-commerce and transportation. Every company that sells things online needs warehouses to store their stuff. You think about, the Amazons. Amazon takes up a lot of space all across the country, and so that's been, one of the bigger differences. And then looking at the opposite side of that, what was really affected, as everybody knows, offices really got crushed by commercial real estate. Obviously, people weren't going into work as much, a ton of vacancy, and what the big thing that we're seeing right now is a lot of debts coming due. So it's tough because people aren't filling the spaces. They have to give concessions. They have to knock down their rents. And office has begun to recover. We saw about a 40% increase in transaction volume in 2025 as we did in 2024. But that's something that we don't necessarily think will be the same ever than it was pre-COVID. And then retail saw a bit of a shift as well. There's not as much in-person retail, again, kind of building off the e-commerce. So we're seeing definitely a price or a flight to quality. And one thing that we've really believed is that this isn't necessarily a recovery cycle that we've seen in the last 4 years. It's a total structural reset. The market's never going to be the same as it was pre-COVID, and investors have started to adjust to that, and we've had to adjust our business to that as well. And so when we're looking at what's really reset from the time that COVID happened till now, we're looking pre-COVID, debt was a lot cheaper and it was easier to get access to capital. People just assumed that the market was going to continue to grow. It was real estate, it was safe, and it always worked. I mean, in 2008, we saw more of the residential market really get crushed, but for the most part, commercial was relatively safe, and it was relatively easy to finance and get cash flowing. And you see this black swan event with COVID, and it really changed everything, and it's made investors a lot more careful, and also lenders a lot more careful. I mean, we're seeing a lot of the deals that we have people get into, you have to have at least 35% down, so 65% loan to value ratio. And people are looking for a decent spread depending on the asset class, but in the industrial space, we're seeing owners demanding a 1 to 1.5% spread between the cost of capital and then the return on investment with cap rates. And a lot of what we're seeing are looking on this right side here, returns to operations. So that's why people are hot on industrial, because industrial is necessary and it's going to continue to get necessary. And when you're looking at retail, we're seeing a lot of movement into net lease deals. With a big thing that our office sells is gas stations. So Wawa's, Sheetz, they're always going to be there. They're always on prime real estate. So people are, again, fleeting to quality and fleeting to safer investments, and occasionally willing to pay a premium for that. And so kind of breaking it down a little bit, sector by sector.
David,
as I said,
can I stop you there for a second? Just a really simple, basic question.
Of course.
I think when industrial is a pretty large term. So could you kind of hit on sort of the different sectors or different types within industrial, just to give everyone kind of a baseline knowledge? Because I think there's probably some that are front of mind for everyone, but maybe there's some that are lesser known or have kind of like come to the surface in the post-COVID world, like small bay industrial parks, things like that.
So we've seen, we focus on, relatively smaller buildings. So that small bay space ranging from 10,000 square feet up to 100, maybe 200,000 square feet. That's really been, from 2020 to 2024, that was really the hottest thing because they thought they were able to lease up these 10,000 to 25,000 square foot suites within these buildings. And the smaller the suite is, the higher rents you're able to get. But again, you see these big companies like Prologis, they're building million square foot warehouses for, building them out for Amazon. That's another thing. You see these bigger buildings, 1 million to 1.5 million square feet. Recently, we're seeing data centers coming up as well. And then in the last 24 to 48 months, a big thing that we're seeing investor demand for is outdoor storage, which is it can involve truck parking. It can involve businesses that do just work outside. I was just meeting with an owner last week of a stone company that has to have 8 acres and they use it to store the materials. That's been a big thing. That includes, again, truck parking as well as truck terminals, where you see maybe 32 cross docks sitting on 4 acres, where the building doesn't take up as much space, but the land is very valuable because it's on a prime location. We sell a lot of buildings up along 78 going across Pennsylvania, but anywhere across a hot corridor, land is necessary. But really, the three things we work on are those bigger buildings over 100,000 square feet, small bay space, again ranging from 10 to 100,000, and then outdoor storage, where it might not be so much building, but it's high quality land that's well taken care of and it's easy to continue to take care of, where people use it just for convenience and transportation purposes. And so, did that answer the question all right, Matt?
Yeah, perfect. Thank you.
Fantastic. So breaking it down a little bit sector by sector, where we've seen the changes. As I said earlier, industrial has really become the sweetheart of commercial real estate. And again, breaking that down piece by piece, investors like these small bay spaces and they like this outdoor storage. And another reason that people like outdoor storage is they can typically demand a bit of a higher return, being that a lot of the time it's just land and it's not as sticky of tenants, because if you can find good land, you can find good land next door as well. And then looking at office. So the resilient subsector of office has been medical office. We're seeing a lot of these buildings with, Tower Health in the Northeast. We have Jefferson and Penn, DaVita dialysis centers, and medical office has remained relatively resilient. People are always going to need medical care, but traditional office space, one thing that we've really been seeing in the last, 12 to 24 months is potential for multifamily redevelopment. People taking these Class A office buildings that are being sold at a heavy discount, purchasing them and flipping them into apartment buildings. But again, there is strength. We just had a report come out yesterday that obviously the New York market is always going to be very strong. Miami is growing; it has continued to be strong. But in these more rural areas, like I work in Philadelphia. Outside of Philadelphia, office market is really struggling to continue to be filled and to sell, and people are demanding cap rates over 10%. You're looking at 10, 11, sometimes even 12% from investors, where pre-COVID we were seeing them in maybe the low 8s and the 9s. So that's been a big difference there. And then multifamily, people always need places to live. One thing that we saw post-COVID in 2021 was very cheap cost of capital. So development was going up everywhere, and a lot of places multifamily was being overbuilt. So in 2023 and 2024, a lot of these owners had to cut rents or hand out concessions where they were giving out 1, 2, sometimes even 3 months free rent to get people to live there, because there was such an abundance of space. And that has started to slowly regulate a little bit over the last 12 months or so, but that's really been a big thing there. And then with retail, again, there's not so much of a demand for, places like a Lululemon, or where you can buy these things online, but we're still seeing a strong desire for, just car washes and gas stations, things that are always going to be necessary and aren't necessarily as much of a luxury. But again, the entire market's changed, and it will continue to change, and we don't think that it will go back to the pre-COVID market the way it was, and we'll continue to adapt with it. But again, a lot of where we're seeing money move into is this industrial outdoor storage from an industrial perspective, as well as some niche industrial. So people will pay more of a premium if the building is built out for something specific. And this is another thing that we see with medical office. If you have a surgical center where they have millions of dollars in equipment, the tenant's going to be less likely to leave, and therefore the investor is willing to pay more of a premium because they have more of a belief that the investor is going to stay. And then from a net lease perspective, people aren't necessarily looking to add value here. They're looking for safe cash flow. So I said my office sells more Wawas than anyone else on the East Coast. We do a lot of Wawas with investors that are just looking for safe returns, almost retirement type returns, where you have a lease for 10, 15, sometimes even 20 years with an absolute triple net lease where it's hands off. You're just looking to get a check in the mail. And you can still get the depreciation as long as it's not just a land lease. But that's really what we're seeing for net lease. And then if you're looking for some value add, there's always multifamily. But for industrial, people are willing to take some risk here, add some value. As I said, those small base spaces are relatively easy to fill, and you can get them occasionally at cheaper prices if they're being sold vacant. That's really where we've been seeing a lot of it go to. And then occasionally the cheap office building. It's, again, transaction volume is nowhere close to where it was pre-COVID with office. But as I said, it was up 40%, at least in Eastern Pennsylvania, in 2025 compared to 2024. So that's really what we've been seeing so far. And then, with changing our underwriting to where we were pre-COVID, a lot of what we value now is tenant durability as well as replacement costs. So if you can buy an industrial building, if you can build an industrial building, let's say for 150 square feet, and we're selling you an industrial building for, $80 a square foot that's vacant, investors are weighing, how much capital do I have to put in to get this tenanted, and what's the difference between rents from the building that I'm buying and a new Class A building that costs $150 a feet. That's a big difference from us. And then we're being careful. We're not cutting down interest rates. We're doing accurate loans. One thing that separates Marcus Millichap from a lot of the smaller brokerages is we actually have our own in-house capital corporation called Marcus Millichap Capital Corporation. So when we underwrite deals, we get soft debt quotes from a handful of lenders in the area that tell us, here's how we would underwrite this deal. Here's the lending terms that we get. And again, a lot of the time, at least for industrial, is 35% down, 65% loan to value. Here's a spread of interest rates we're seeing right now. Again, just in the industrial sector, 6.25% roughly, with a 5-year term amortized over 20 years. But a lot of our underwriting is hand in hand with our capital corporation, and again, try to get as much due diligence done up front. You want to be underwriting responsibly to get deals done now. And then, a lot of what we saw looking at this rate compression down here in the bottom right, in 2023 and 2024, investors were really sitting on their hands, not doing much. 2024 was, again, from an industrial perspective, the lowest volume we had seen since COVID. And what we've seen in the last 12 to 18 months is investors can't sit around anymore. They need to move. So they're not necessarily waiting for rate compression. They're going out and searching for deals. And our CEO said last year in a investor relation thing we had is the only certainty is uncertainty. So everybody, nobody knows what's going to happen in the markets today or tomorrow. Last week we were going into a war. Last night we were told that the war is coming to an end. But the world goes on, and we keep moving. Investors keep moving, and that's really a big thing that we've seen recently. And I think looking into the post-COVID world, the best real estate is going to be based on infrastructure. It's going to be based on quality of land, quality of tenant, and then quality of asset. Industrial buildings have gone up because transportation will continue to grow, e-commerce will continue to grow, and people need places to keep their stuff. And then looking, into from an income perspective, people are demanding these longer term leases with credit-backed tenants, and they like them in places where there's always going to be a demand. So if you look 30 minutes outside of a major metro, it might be harder to find, or just from our perspective, it's going to be harder to sell a deal than if you're in downtown Philadelphia or in New York City or in downtown Miami. So we're seeing a lot of interest in these bigger metros and a lot less interest in those more tertiary markets. So that's really a big thing. And then we have a little bit of a case study that I'll go into about a deal that we're currently selling outside of Philadelphia. It's a Wawa. And just again, touching a little bit more on why people are valuing these triple net deals, why net lease. It's just for the consistent credit backed cash flow. People know of Wawa, they know of Sheetz, and they like these tenants. And again, they're willing to pay a little bit of a premium. And it's not necessarily to add value. Sometimes your cap rates and your return on investments are only in the 5 to 6% range. But a lot of the time, it's almost for estate planning. People buy these just for a peace of mind, where they have little volatility in value. The landlord has little to no responsibility. Oftentimes, you have an absolute net lease, and it just gives you peace of mind. You get a check in the mail, and that's more or less all you do. So we're seeing a lot of desire for quality tenants on quality land, where the real estate's always going to be valuable and the tenant's always going to be paying their rent on time. So going into a little bit more of this deal that we're currently selling, it's a Wawa located in Glen Olden, Pennsylvania, which is just west of Philadelphia in Delaware County. We have it currently offered for $2.3 million on a 10-year lease with renewals at the end, currently bringing in about $181,000 a year, which is a bit of a higher return than what we see from a lot of Wawas. The catch here with this one is it's a double net lease, so the owner or the landlord is still responsible for some insurance, and then the lease doesn't have annual rent bumps. The rent bumps at renewal of lease, so that's, we offered a little bit higher of a cap rate than if they had 2% annual bumps or 3% annual bumps every 2 years. And that's the reason you can find a higher return on this Wawa. And breaking it down here, I guess I'll let Carl take into this a little more. Carl, you want to take this part? Oh, can you hear me?
See, Carl, you might be on mute.
Can you hear me?
Yeah.
So one of the things that, hang on a minute, I've got some feedback here. One of the things that I like about what you're talking about is with a Wawa is the passive income. As I get older, I want to have passive income, and if you really understand that, the money coming in on a triple net lease is much different than a single family owned home. So I really like that aspect of it. But what's even better, I think, is using IRAs and 401ks for collecting your rent, because that rent is basically tax-free income for the rest of your life. This slide here, the numbers kind of tell you the savings that you'll get. As an example, on your Wawa that you're talking about, there's about $181,000 that comes in. And obviously you get depreciation on the property, which is about $47,000. And you don't have to look at these numbers. If you want direct, exact numbers, call our office and we'll go through it with you with the deal. So the taxable income on the Roth IRA is 181 is zero, right? There is no tax in the Roth IRA, and the Wawa in the personal taxable account, your income you're going to get taxed on is 134,000 because you get to save 47,000 in depreciation. So basically, you're paying $50,000 in taxes. So by filling out a Roth IRA application and buying the property in the Roth, you save $50,000 a year. You do that over 10 years, and you're saving, $500,000. And then the other thing too is when you go to sell the property, you're going to have to pay recapture tax in and outside the IRA. And inside the IRA, you don't pay any recapture tax. So you're basically, in this deal here that we're looking at, over 10 years, you're making an extra $700,000. So I've been in real estate. My mom and dad were in real estate, and their moms and dads were in real estate. So when I found out the use of IRAs and 401ks, tax advantage plans, it just made a lot of sense to start putting real estate into my IRA because I knew real estate and I liked it. And then I get to see more income. And now that I'm over 59 and a half, I get to take it out tax free. And there are no RMDs on it. So do we have another slide or is that the last one?
That's the last one. Just got some contact
Okay.
information here at the end.
All right. So if people do want to, if people
Actually,
do
I
want
wanted to-
more information
I
on
wanted to ask
IRAs and
quick question
401.
for David, actually. So sorry,
Yep.
Carl.
All right. No, go ahead.
So Carl was mentioning, like what he's looking for in an investment, when he's looking for something more passive. Can you talk, David, a little bit about like who are the types of people who are buying these Wawas, and besides just a single party doing an outright purchase, what are some of the other acquisition structures you've seen in terms of multiple buyers coming in?
Yeah. Occasionally you can have joint ventures where you have a handful of investors come through and pull some capital and get into deals like that. Obviously, we work with a lot of people when you're going into these bigger deals where maybe it's one individual that's running point, but they've sourced capital from a handful of different investors. Or we work with a lot of bigger developers that are sometimes looking to just park some capital for the time being. One quick deal story we had last year of someone trading in. They were in a 1031 exchange trading into Wawa's. Is they had spent their life in building shopping centers, and they built about $20 million worth of shopping centers. They hired me and my firm to go and sell them. We sold them for about $20 million, and they didn't want to pay their taxes yet. They wanted to defer them with the 1031, and they wanted to leave their real estate to their family so they could sell it at a stepped up basis when the time came where the owner passed. So we sold them for about 20 million, traded them into 3 triple net Wawa deals where it's totally hands off, and they're currently just cash flowing the Wawas. And whenever they pass away, those that are going to inherit the buildings will inherit them at a stepped up basis. And that's really one scenario that we see for a lot of people that are using this for almost estate planning purposes.
Yeah.
But again, you can pull money in a joint venture. Sometimes there are bigger funds that you're able to invest in and kind of go hands off, such as Delaware statutory trusts or real estate investment trusts. That's really what we're seeing so far.
Cool. Thanks a lot for that. And then Carl, a question for you, and that we don't need to go too into the weeds on it, but the purchase price for the Wawa that we're talking about is $2.3 million. Let's say I have an IRA. I don't have $2.3 million in my IRA, but I'm interested in doing something like this, so I want to take a loan. Can you just talk at a pretty high level about what that would look like and some sort of considerations if you were going to buy this with debt?
Sure. Can you hear me?
Yep.
Gotcha.
Hang on one second. I'm having problems with my Wi-Fi here. But yeah, if you're going to take a loan, generally you're going to need to have 30% down, and there'll be what's called unrelated business income tax because you took that loan, or UDFI. But at that point, you'll be able to offset some of those taxes with depreciation, et cetera. So I don't worry about UBIT, but I would always look at it ahead of time and then determine, what the final outcome with the income is. It would obviously be a little bit less than what we showed on that other sheet, but call the office and I'll be glad to go over UBIT and unrelated debt financed income. But you can buy those Wawas like that with the passive income. And I think that those are great investments in today's world when you really want something passive. And I always used to tell people, UBIT, you bet. If you're paying taxes, then you're making a lot of money. So don't let UBIT or UDFI scare you away. At least look at the numbers and let us help you.
Awesome. I'm going to steal that one. All right. So we have some contact information there. David, anything you want to share about reaching out to you? Or...
No, feel free to reach out anytime if you have any questions about, potentially investing in any of our deals. Happy to send them out. We have them all across the country in all different asset classes. Or if you own any commercial real estate and we're ever thinking about potentially 1031ing out of it, or just interested in property valuations, it's something that my company does completely free of charge. Always happy to give you an idea of what the market looks like around you and where your properties sit and how to potentially add some value there. But that's more or less it. Feel free to reach me on my phone number or my email there anytime. I'm typically pretty quick with getting back to people. So I'm always happy to have a conversation about some real estate.
Awesome.
Okay, so let me just ask you a question, Dave.
Yeah.
And you went over kind of what's hot and what's not. But what do you see as the biggest changes for the rest of 26 and going into 27? And what's your inventory look like?
Plenty of inventory, especially all across the country. This time last year, we had more inventory than we even had right post COVID. And last year, we ended up doing about $53 billion worth of sales. So money's moving, and I'll kind of go back to the line I said earlier. The only certainty is uncertainty. We're not quite sure, and we can't really give predictions on where rates are going to move. But I will say we have continued confidence in the industrial sector and quality real estate with quality tenants and triple net deals. But again, the only certainty is uncertainty, especially with the economic state of the world and what we're seeing with what's going on in the Middle East right now. So uncertainty, I guess, is where I say what we're seeing so far.
Well, you've spiked my curiosity with the Wawas and the Sheetz. And they look like right now they're Amazon proof, but like CVS and Walgreens used to be another
Yep.
triple net tenant that you could lease the land to, and you'd have 10, 15, 20-year leases with them. Are those still going as well as they are with all the mail out drugs, et cetera?
CVS's or Wawa's?
CVS's. Wawa's, I don't see any change in that.
Those should be great for a good time. CVS's, the credit has been, a little bit questioned, especially with the Rite Aids and a lot of those other, type of buildings going out of business or businesses going out of business. We're seeing, cap rates starting to move up, building values go down for a lot of those. It kind of goes back to the point earlier with quality tenants on quality real estates. The tenant quality for those CVS's and those Walgreens has come down in recent years as their credit hasn't been as great and they've shut down stores. But a few owners are still, they're still doing okay when they're in good locations. And even if CVS has to leave, if you're a corner lot in a good town or a good city, it's typically not the most difficult thing to fill those up. So if you're looking to do it for retirement, I wouldn't necessarily say that CVS's are the way to go. But that's just kind of what we've seen in recent years. And we've sold a few CVS's and Rite Aids, but we've seen in recent years is, cap rates starting to move up on those from where they were pre-COVID. So definitely becoming a little bit less desirable as time's going on.
Okay, that's pretty good. And one of the reasons we like working with M&M is that you guys deal with private individuals. You're not like the CBR Ellis, where all the institutions are going to.
Mm-hmm.
So it's a little bit easier for individuals and private equity to work with you guys. Is that still the case?
Absolutely. Work with a ton of mom and pops and a ton of business owners, especially in the industrial space. But we really break it down to a lot of, tier 2s and 3s is what we call them. So individuals that own, 5+ buildings down to individuals that own one, maybe have inherited it from family, used it for their business. So we do work primarily and mostly with private individuals. Not to say we don't bring institutional capital to deals, but that is our primary clientele.
Gotcha. And I think coupling this with the IRA and the 401k and upping your returns by, 30 to 40% seems like an ideal way to, especially if you're getting older in your retirement and you want less headaches and more passivity. These types of investments are there. But you guys aren't just held to that. You have multifamily
Correct.
and
Every asset we
strip
sell.
malls and everything. You're just using the Wawa as one example.
Yeah, we sell golf courses. If you ever want to buy a golf course, so we got it
Okay.
all over the place.
Nice.
All righty. All right.
We
Well, I
had-
very much appreciate you taking the time and coming today. And I hope people reach out to you and use their IRAs to purchase the properties that you can help them get a hold on.
All right, not so fast, Carl. We did have a question come in, and I can show it. I'll read it out. Where are you seeing cap rates shake out for high credit net lease industrial properties? Are you seeing decent leasing velocity for spec industrial that are not single tenant assets?
So, we sold a deal in downtown Philly, or just north of downtown Philly last year, for about a 7.25 cap. So, depending on the tenant and lease term, you can push cap rates down to the low sevens, sometimes even into the upper sixes if it's a really solid tenant. And then as tenancy gets a little bit smaller, maybe pushing up into the upper sevens. But I'd say low sevens if you got a really good high quality tenant in there. And then again, depending on location, sometimes even down to the sixes. And then the second part of that it was about filling space with spec spaces, was it, Matt?
Correct.
So leasing has been, heavily determined by location. The Sunbelt states, we've seen leasing activity really pick up. Throughout Northeast Pennsylvania, it was really hot in the last, 3 or 4 years and started to slow down later last year. But anything, 10,000 square feet and below, sometimes maybe even 20,000 square feet and below, typically isn't terribly hard to fill, again, in decent markets. A lot of the vacancy that we see is in these bigger boxes, 100,000 square feet and above. But if you're priced correctly, typically space has been filling relatively quick.
Yeah.
Nice.
Yeah, Dave, what I've seen, at the end of 24 and most of 25 are the big warehouses that Amazon is using and Walmart are using for their distribution centers, so that they can cut down time and gas, et cetera. And I, to me, it feels like those have slowed down, but I'm not sure. Do you guys get into those at all?
So not typically, and again, we do strictly sales, not leasing. So we have plenty of leasing data. But no, a lot of the vacancy that we've seen specifically in, the eastern side of Pennsylvania where I specialize, is in those big boxes. They were very, built very quickly. And when capital was cheap in 21 and 22, and now a lot of them are sitting there vacant or partially vacant, which has been part of the reason why small bay has been so desirable for a lot of investors in the area.
Cool. Thank you.
Of course.
All right. Just to echo what Carl was saying earlier, thanks very much, David, for joining us today and dropping knowledge on the webinar. There is the contact information for David, so please don't hesitate to reach out to him. And then if you have an IRA related question or you want to learn more, please don't hesitate to reach out to me at Camoplan. So you have my contact information right there in front of you. And just like that, we got one more question. So we'll make this the last question before we end the show. So this is related to the big box question. And on those big boxes, 100,000 square feet, what kind of concessions are you seeing on these properties, David?
Less about concessions, and sometimes it's about, build out, similar to what we're seeing with offices, where you'll give them a little bit of TI for, building, relative to their business. So helping with, materials or cranes and whatnot. But in industrial, a lot of it's just cutting rents down a little bit, rather than, what you see with multifamily where it's a couple free months and whatnot, or offices where they're really starting to see some concessions. but a lot of it's rent related, I would suppose.
Cool. Okay. Thanks a lot for both those questions from our audience. And again, David, thanks very much for joining us today. Any closing thoughts before we go?
All good. Easiest way, if anyone's interested in reaching out, easiest way is typically by email. Sometimes harder to get on the phone during the day, but feel free to reach out via email anytime.
Cool. And then Carl, any closing thoughts before we end the webinar?
No, I just appreciate everybody being on today, and I hope they've learned a little bit about where the commercial private investments are, talk about some passivity, and I hope they take advantage of using their IRAs and 401ks to purchase their next piece of property and create tax-free income for the rest of their life.
Well said. All right. Thanks very much, everyone, for joining, and have a great rest of your day. We'll see you on the next one.